Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome to another Market Radar podcast. It's September 11th. Year-to-date performances. Let's get started with these. S&P is now down 14.39%. NASDAQ is down 22.81%. The Russell is down 15.76%. The Dow Jones is down 11.3%. All indexes continue to be bearish trend. There is a total chance of risk off of 60% right now. We did see a slight tick up in stagflation and deflation odds. So more strength towards risk off regime, which we've been in for a while. Inflation odds pulled back a little bit, which it's something we have our eye on just in case we do get a risk on regime. It is very possible. Let's look at the calendar for next week. It's a pretty big week coming up. Monday we've got nothing, but Tuesday we've got CPI, so we'll keep an eye on that one. And we've got a Treasury statement. Wednesday we've got PPI final demand and EIA petroleum status report. Thursday, we've got jobless claims, Philadelphia Fed Manufacturing Index, retail sales, Empire State Manufacturing Index, import and export prices, industrial production, business inventories, EIA natural gas report, and the Fed balance sheet. Very big day on Thursday. Friday, we've got consumer sentiment and Treasury International Capital. Gamma, do you want to go through the recap of last week?
Yeah, so let's start with that, and then we're going to go over ES and ZN. So let me bring up the charts for you guys. So during last week, we had the S&P Global Composite PMI for August come in missing estimates at 44.6. The forecast was for 45, and the prior figure was 47.7. So we're seeing consecutive lower values as this remains under 50, signaling a contraction is still underway. We had services PMI for August come in missing estimates at 43.7. The forecast was for 44.3, and the prior figure was for 47.3. We're seeing gradually lower values here as well, while remaining under 50, also signaling a contraction is underway here as well. We had ISM non-manufacturing employment as of August come in at 50.2. The prior figure was 49.1. So we're seeing this slowly creep back above 50. And remember, with the 50 level signaling, anything under can signal contraction, anything over signaling expansion. So we've been chopping around this 50 for quite some time. So we're starting to see this go back above 50. The last two prints were under 50. We had ISM non-manufacturing PMI as of August come in beating estimates at 56.9. The forecast was for 55.1, and the prior figure was for 56.7. This has yet to break below 50 and has now posted its second consecutive increase in print. We had trade balance for July come in missing estimates at negative 70.7 billion. The forecast was for negative 70.3 billion. So still overall an increase from the prior figure, which was a negative 80.9 billion. So this also saw its fourth consecutive increase in print as the trade balance repairs its deficit of most of 2022. Typically, a more positive trade balance is seen as a bullish event for the country's currency. Here we have jobless claims last week came in beating estimates to the downside at 222,000. The forecast was for 240,000, and the prior figure was 228,000. This is the fourth straight decline in claims on a week-over-week basis, and month-over-month and year-over-year rate of changes remain in negative territory, signaling that the continuation remains as in the tight labor market. We also had the beige book last week. Now, for those who don't know what this is basically the economic cliff notes made by or created by each district of the Federal Reserve and provided to policymakers of the central bank before each FOMC meeting. The report summarized that the outlook for future economic growth remained generally weak, with contacts noting expectations for further softening of demand over the next 6 to 12 months. So not a overall bullish outlook, and it's something that we're going to have to watch with the market in the next few weeks or a few months, I should say, and how they progress into the end of the year with the upcoming rate hikes and the overall slowing economy. We had crude oil inventories come in hugely over estimates at positive 8.844 million. The forecast was for negative 250,000, so a huge beat there. And the prior figure was negative 3.326 million. Now, this was the largest print since May of this year, and we're definitely starting to see a flip here on the inventories with their abilities to signal more consistent prints in positive territory. Crude remains in bearish trend since July, signaling that energy is no longer a favorable allocation. But the system doesn't want to put in a short just yet as stagflation continues to hold the reins. And as you can see here, I have crude overlaying the oil stock changes or oil or crude oil inventories. And as we start to see more and more positive prints or consecutive positive prints, we're starting to see more or more weaker price action. And as we were seeing more consecutive negative prints, we were seeing much stronger price action. And this is something just to watch. I mean, it's not the end all or be all, but it's just something to see how things are progressing as we go forward here. Now, let's get into ES and what happened last week.
So got a pretty strong close into the end of the week. This is just another sign of why we've been saying leverage is not your friend right now. All of the late shorts getting burned hard. The way to play this is entering shorts as we've been doing at Momo with break of Momo as your stop loss, and just not going heavy size because this market will whipsaw you. Stagflation is known for that.
Yeah, that's definitely spot on because a lot of people down here were saying, "Oh, now's a good time to get short." Primarily, and this is why we don't use trend lines. This is going to be a case in point. But if we were to take a trend line and we were to put this just as in this manner, remember we added shorts up here. Okay, if you're gonna do any type of trend line trading, which we don't do, you would be shorting somewhere down here, right? A break of trend line. That's typical textbook shit. Now
Mhm.
you go short here, your trade location or positioning location is way off, right? Because Momo is the trend, not this fucking line here. So if this wants to go up and squeeze, well, our location now at this point where we added some shorts, especially the ES or SPX short, um, we have some room now to work with that short, right? Getting short here, you're pretty much break even now. So now you have a bunch of room where the trade can still be in your favor, right? But you may have to get stopped out. And that's the big reason why we don't don't chase trend lines, all these basic technical analysis methods, because at the end of the day, we want something that provides consistent trade location, trend positioning, and obviously that's what DDAP helps us do. Now, squeezing up here, could ES get all the way up to 4230s? Yeah, it's possible. That's another 3.5% from here to the upside. It's definitely possible. Will it suck? Will we get a little bit of a drawdown? Yeah. I mean, will we continue to draw down, off the lows? Yeah. But it is what it is. At the end of the day, like we are positioned in stagflation for this reason. We understand the chop. We understand that markets can chop lower, but we hold the positions that we hold because there is no direction. And the odds remain in favor for a risk off environment if that is stagflation or deflation. Now, any pivot in any of those directions, meaning let's just say we get the pivot from stagflation to deflation, our portfolio will do fine, meaning the shorts that we have will work in both environments, which is why we're holding them. We're not long bonds yet. Bonds aren't the trade. And we're not long equities because equities aren't to trade either. So we are in a very tough position. The market's in a very tough position. And we have to abide by the rules. And that's what we're doing here. And if we go to
We're also positioned in a way where if we do get a risk on inflationary regime, this is going to blow past Momo for that to happen. And we're we're not out of the game if that happens. Yeah, the portfolio will probably take a little loss, but then it's risk on, baby, and we're coming back if that happens. So we're really positioned in a way where no matter which direction the market picks, we'll be okay.
yeah, exactly. And I mean, even if there's a directional risk off regime, we'll come back that way too. Like it doesn't it's not about listen, risk on is great, but we can manage both environments. That's important. So pay attention to the bigger picture, pay attention to the system. It'll guide you, it'll set the tone for what's going to come. And we can obviously see that with bonds. The bond trade remains I mean, the bond trade remains fucked. Quite just simply. Like
Yeah.
you're
Well, we're
yeah.
we're heading back to the lows just like we've called
Yeah.
over a month ago.
Yeah, when bonds were up here, everyone wants to get bullish, right? Again, we could draw the little trend line on bonds. You know, the breakout, right? You're buying here. Oh, cool. Now you're break even. You're like, oh, I got to cut it. Whatever. Long story short, you can trade the vamps. The vamps are there as volatility ranges. They can be traded even in counter trends. We don't do that because again, it goes against our process. But long story short, overall, I know some of the people in our room have made money on some of these counter trend moves within bearish trends, but it's not something that we will harp publicly because it's not something that follows our protocol and the stability of what the system is supposed to represent. So, for that being, bonds remain unfavorable until they are bullish trends. So, this is all bullshit. Lower prices are to be expected because the trend is bearish. Unless something changes, we're going to sit here and chirp lower prices all day long because that's what the trend is telling us. And that's what the system is aligning itself for a non directional regime because of bonds not having a trend. If bonds were to have a trend, we'd have a directional regime. Until bonds have a trend, the system remains non directional. Equities and bonds are both to be faded. And I think we can go from this into the main topic today, which is something that I wanted to speak about for a while, and it's something that's quite controversial because of who is having this conversation, and we'll go into that in detail in a few minutes. But the scope of the conversation today is going to be why is the dollar, the U.S. dollar, the king, right? Now, let's before we go into this, let's bring up a chart of the DX futures, and here we go. So we're at 108 0.99, basically 109, and this has been pretty much on a tear ever since July of last year, and this is putting in an epic bullish trend, destroying currencies all around the world in the process, or their destruction in turn is providing such an immense rally. Now, there are many theories why the dollar is the king, but some of this is going to be my opinion and some of this is going to be fact. But I believe it comes down to three simple reasons, okay? The United States of America is the wealthiest country. 30% of the world's wealth is held within the United States. We have the strongest military and we have so many foreign influences that our currency is adopted everywhere. Meaning our military, the military of the United States has bases all around. It's established itself all around the world, so it's widely accepted as a reserve currency. And as of 2021, the world reserves of the US dollar sat around 59%. This was 2021. And the euro sat around 21%. So the euro was the closest competitor at 21%, and the dollar was at 59%. That's why it's considered the world reserve currency. The problem is this was as of 2021. Since then, the euro has shit the bed, basically taken a bloodbath, right? So you can now only assume that the dollar has gained some ground in that respect of world reserve status because it is just that safe. Look at the euro. No one wants. Who wants to own euros? Who wants to own yens? Who wants to own even pounds? The dollar has shown itself again that it is in fact still the world's reserve currency. Not fucking Bitcoin, not your shitcoin, whatever you got, crypto plays you got. It's just not the case. It is the
And
US
so
dollar.
what is the main reason for that? Is that just because of the history behind the dollar, or is it because of the Federal Reserve?
I
What's the
think,
reason
I think,
people flock to it?
I think it has to do with the fact that, look, the United States is one of the it, it comes down to economies of scale, right? So if you own US dollars, you own a piece of like a really robust economy that is perceived to not really go too far off the tracks, right? Before being put back in place. Now, I know we're going to cry about 9% inflation, but if you look at places like Argentina, they're shit in the bed, and none of those scenarios compared to the United States, right? At least not yet, because we're at 9% inflation, and the Federal Reserve has come out publicly devoting everything they have to do to control inflation. And I believe they will get inflation under control at some point. And if they don't, then yeah, the dollar really does pose a risk of losing world reserve currency status. But I do think that the central bank, Powell, all these guys, all these big heads, they know that inflation has to get taken under control rather quickly because of its status of a world reserve currency. Now, a lot of people have faith in the United States. If it's repayments of debt. Again, the United States can just print money, right, to repay debt. So there's the faith there is not the same as. I should say this: the United States has the ability to repay its debt. The idea is the faith in the country to repay its debt without do encompassing dramatic inflation in the process, right? Where they're not going to just continuously print to oblivion, which in some ways we are. But if you look at Argentina, right, and their inflation rates, you look at America, it's obviously not the same thing.
So
So
it's all relative,
right,
right?
exactly.
So
Yeah.
yeah, America's got 9% inflation, but it's better than what other countries are doing.
Yeah, but you're also holding, basically, you're holding a piece of a robust economy, right? Now, there's a lot of people that will say, like, China, right, is a huge economy. It's up and coming. But in reality, let's be honest, with all due respect, this is not meant in a derogatory way, but they're really good at utilizing and not creating, right? So they're the king of IP theft, and that puts them at a disadvantage when it comes to innovating their economies and pushing it forward. They have some components of socialism, um, which prevents the positive influence of forward thinking, right? And there's a lot of things that go into their economy that we don't need to talk. It's out of the scope of this conversation. And I know that this is just going to sound ridiculous, but when it comes to dollar ownership, like, who doesn't want monetary access to the world's strongest and most influential power? And that's the United States, right? The United States is the spider web that goes around the whole world. If you can pretty much go to any country and they'll accept the US dollar,
Right.
right? So that's just it's a self-fulfilling prophecy, right? Because the dollar's components, and we can bring up the dollar dominance right here, so you can see what I'm talking about with composition. So 59% being US dollars, 21% being euro, and the others don't even match up to the dollar in reserve status worldwide. Now, this is a self-fulfilling prophecy to a certain degree, because let's just say you have euros, right? And you have dollar, you have dollar. There's euros and there's dollars, and you're in Europe. Well, if your country's suffering inflation that is worse than America, and the dollar is the reserve currency there, you're going to move more assets to dollars, right? Because it's considered the world reserve currency. It's stable. Now, it might not be the best in stability wise to other currencies out there. There might be more stable central banks, but in regards to robustness overall, the dollar is the king. So you as a euro holder will start moving money to dollars, and it becomes a self-fulfilling prophecy, because as euro starts to lack more and more demand, it continues to just shit the bed even more and more, the dollar demand becomes bigger and bigger and bigger, right? It's almost like, if it's so stable, the more people that believe in it, the more stable that it becomes, right? Just like how if someone loses, if the more faith that's lost in a currency, the worse and worse it becomes, because then nobody wants it.
Yeah. So what needs to happen to break this cycle, this self-fulfilling prophecy?
Well, this is a good conversation that we're going to talk about today, because if we look at the dollar, let's look at the dollar basket as a whole, and let's look at the, let's first discuss the issues to break the cycle, right? So to break the cycle, we need to break the components that make up the dollar. The dollar needs to be seen as a worse performer against its components, thus not holding any value into the foreign currencies that are being swapped for dollars, right? So if we look at a regular dollar index here, you'll see it in white, and then in orange we have the trade weighted U.S. dollar index. So it's important to understand how the dollar index is composed. The dollar index has basically remained unchanged since like the 1970s or 80s. In 1999, the euro was implemented, and all that happened to the dollar index was the euro's value was rolled together from all the currencies that were prior to the euro. So like there was um, Italy had its own currency, the German mark, all these other currencies that make up the euro. They were rolled into the euro, and those compositions were rolled into the euro's weighting of the dollar index. So even though the index weighting somewhat changed, it was all in relation and didn't really change weighting wise. It was just rolled into one big weight.
So so each currency kind of has its own fixed weight against the dollar.
Right. And that what I mean to say is that fixed weight has not changed pretty much since the inception.
Okay.
Okay. Now, um, the euro's weight of the dollar, we'll go over that in a little bit, is a major role in both of these trade weighted and DXY examples. But the DXY hasn't changed in so many years, and some people will say things like the Swiss franc and the Swedish krona are like, I think total. We have the math right here. We could look at it. So the Swedish franc, the Swedish krona, and the Swiss franc make up almost 8% of the dollar index, right? So as trade has progressed over the years, there's other currencies that are major trade partners with America, and they don't get the accurate trade weightings within the DXY because the weightings themselves have not been changed. So that's where the trade weighted US dollar comes in. And this is produced by the Fed. And then there's also the Bloomberg dollar index, which is a hybrid between both of these two. Okay. But so if you look at these other, if we look at these other dollar indexes, because obviously I've just named three of them to you, the most reliable one, unfortunately, is the one that has not been updated because it's the one that can be traded. It's the most liquid index that you can find. Bloomberg is proprietary to Bloomberg. You need a terminal to see it. The trade weighted dollar is delayed. Okay, it's produced by the Fed, and the only one that's actively traded is the ICE DXYX futures, which you see on the white line here. And those are, oh, do I have DX? Hold on. I think I have the regular one, but you get the point. If I put here we go. Yeah, there we go.
Yeah. Yeah, so there is a spread between those two prices.
Right, and they peak and they trough at different prices, right? So if we take away the futures contracts, the trade weighted dollar has not broken its 2020 high yet, right? But if we add the regular dollar index, it's well surpasses 2020 high, and
Yeah, that's interesting.
yeah, and that's just due to the major trade component differences and whatnot. But that's not so much important because at the end of the day, we can worry about these other dollar indexes, but it's almost like even though the DXY, the original DXY, the tradable one, is not as efficient, it is in a market pricing perspective. Because if you want to buy dollars on the open market, you're buying DXY. You're not buying these other exchange traded funds, or excuse me, not exchange. I'm sorry, I blanked that. These exchange or trade weighted funds, if it's on Bloomberg or if it's on via the Fed, you can't buy those. Those are indexes that are priced, and I'm sure someone out there has a derivative for this shit. But regardless, it's not easily accessible. And when you're buying on the ICE DXYX futures, right, the ones on my screen here in white, you're basically inversely short the euro. Because those are the components that make the index, right?
hmm
So
So that trade also affects the price of it, right?
Of course,
So would
yes.
that also contribute to the spread between the other versions of
Yes.
DXY?
Well, what's more contributing to this spread is not so much the trades that are getting done, it's the underlying baskets of currencies. So, um the trade weighted US dollar is updated. It's updated occasionally. The weightings are updated. The regular one is the DX futures, the DXYX futures. What they're known on TradingView as DX1, right? But the DX futures, we'll just call them that to make it simple. The DX futures are not updated. The ratings have been the same for over 40 years,
Mhm.
right?
Yeah.
So in that case, the reason that this throughout this time weightings could have changed on the trade weighted US dollar. So the or since inception, right? So the movement of the trade weighted US dollar is not going to be as consistent as the DX futures because the DX futures require and we're going to go over that in a second, the following components to move in a certain way for the price to move, right? Because the dollar is merely a reflection of other currencies. And that's where we're going to go and talk about the dollar composition. So let's go over dollar composition, right? Here we go. We have these are all quoted in the price to acquire $1. Okay. How many of each foreign currency is required to produce $1?
Okay. And then that weight in column B, is that the set weight that we've had for 40 plus years?
Yes, this is the weight. So this should be a percentage, but for the calculations, we left it a decimal. So this has been the same since 19 whatever 70 something when the dollar index was established. This is the dollar base value. Okay, so this is the value of the dollar without these weightings. This is the starting point. This was the starting point prior to the integration of all these foreign currencies. Okay, so this is the price, the value of each currency to get $1, right? So €1
Mhm.
is equal to this many dollars. 1 yen
I see.
is equal
And
to
that's
this many dollars.
as of Friday?
As of Friday, right? And obviously the spread the components that are being used to comprise the dollar index are not what we're finding on. There's so many different forex exchanges that, yeah, I mean they're close, but they do differ between exchanges. And I did get, I mean the one it's a 109.02. If we go back to the dollar, look, we're looking at 108. So we're pretty much there. We're 3 cents shy from what's being reported. So if we look at the current DXY value, this is as of today, and we go over here and we're going to adjust the price to give you an idea of how this is computed. So we've seen the euro US dollar pretty much fall off a cliff, right? It's been falling. We just hit parity. It's been falling down. Same with the yen all
Mhm.
year. These are the year to date performances, right? So this is where we are year to date, and these are the adjusted weights. You don't have to pay any attention to the adjusted weights column. Just pay attention to the price and to the year to date declines, and obviously the weighting is fixed. So we are down 11%, pretty much almost 12%, 19%, and 14% on the top three components of the dollar. So 83% of the United States dollar, its components are down on an average of 15.12%. So that's obviously why you've been seeing this dollar rally. It's just bullish for the dollar. The dollar really started taking off in 2020, which the year-to-date declines contribute towards this rally. Now,
Mhm.
the problem we're running into, and I'm going to go back to what you said earlier, is how does the dollar carnage or the dollar rocket lose its fuel and fall back to earth? Well, if we want to take a short bet against the dollar, aka the dollar peaking and falling back, the components would have to do a 180, right? Because the dollar is going to be a composition of its components. Only 50 points of the dollar's value is stuck at 50.14, right? The other values are dynamically inversed against its relating component currencies. So if you want to see the dollar trend break, and we're going to drag this over here so we can go over this. If you want to see the dollar fall off a cliff, well, you're going to need to see these values rebound. Now, for example, let's just say we want a, let's just say we see the euro bounce back to 1.2, right? Okay, dollar's down to 98. So if the euro runs 20%, the dollar will be back down to here.
Yeah, but how are they going to rally 20%
That's a good point. And
if
that
there's that momentum behind it and it's in relation to the US dollar, right? So as this self-fulfilling prophecy continues, why would it ever
my point.
rally up 20%?
My point is, and I think that we've had this conversation before, I think the euro is fundamentally broken, right? I think that the composition and the way the euro works is fundamentally flawed. You have too many moving parts under one specific currency. The euro is basically a baby version of the entire world using one currency. Think about how fucked that would be.
That's why the global currency idea would never work.
Right, because there would then at that point, if that were the case, you could never have one central bank, right? The idea of a central bank could not be used if you have one currency worldwide, because now you have one governing body controlling the entire world's um, currency supply, right? Tightening, easing, and then the interest rates related to that currency, which you would just have it would be so bad that you would end up actually having countries fight their way out and develop their own currency back to what we have right now. There's a reason why we have so many different currencies. It's
Well,
not
yeah,
just
because
it's
it's different economies,
yes,
different resources. At the end of the day, the main currency is resources.
right,
Cash is just a way to transact resources easier.
right. And my this is my opinion now. I think that the euro there's a good chance in the next I'd say 10 years that the euro breaks back up. I think that the ECB was the central bank idea for all of Europe was a good idea on paper with the euro, but it's not something that could be implemented in reality. The problem is if the euro goes bust, it'll have to break up, which will get all the subcomponents from it. And the problem is the reasoning for that is you take a country like Germany and a country like Greece. I mean, you could just let's talk about work ethics. What is produced in Greece that is used worldwide?
I mean, they're just purely tourism, right?
Yeah, well, yeah. I
They
mean,
don't really
yeah,
they don't really have any exports, I don't think.
and it's not something that, and if they do, it's nothing major. I mean, listen, the only thing that I understand that I'm using that from Greek is some recipes. That's really like all you know. I don't think it's.
Some
I
nice
don't.
some nice Greek potatoes.
Yeah, but like, no offense to them. Listen, they have a beautiful country, and I think that the beautiful country inhibits a lazy work ethic. I don't listen again. No insult. If you're Greek, I really do mean no insult, no harm in saying this, but there's a reason why that country is going bankrupt like every other day. And Euro, the entire ECB is having to consistently watch over these countries. Even Italy. Italy's another one. Listen, they export some more shit, but like at the end of the day, I really don't want this to get like this, but they are obviously not as productive as say Germany, right? Now, I am not going to insult anyone. That's not my intention. But you have countries that have more upper scale work ethics that are paying the price for laziness. Reality, Italy should have its own currency. Greece should have its own currency, and Germany should have its own currency, and so on and so forth. There should not be no such thing as the ECB. But the problem is then you get the people that look at Greece. If Greece had its own currency, it would have extreme problems because now you have isolated inflation. The entire Greek economy is encompassed under the ECB and the ECB and the eurozone inflation, right? So if Greece, not Greece, excuse me, if Greece is isolated, Italy is isolated. Now they have their own inflation components they have to handle. So in some ways, the euro did do its job by stabilizing inflation. Well, I mean, it's not stable, but e- averaging out inflation of the currency over different countries. They took I don't want to
Yeah,
use the
like
word.
some countries suffer and some do better
I don't
under
want to
it,
say shitty countries.
right?
I really look. Greece is a beautiful place, but I don't want to say shitty. I want to say they. You know what? We'll put it this way:
Well,
they take
they're just not as economically
productive.
strong.
Yes, that's a
Yeah.
good way to put it. And you have weak economic countries being averaged out by stronger economic countries that in turn their currencies more evened out. That part has made sense with the euro, right? But the problem is you have to constantly stimulate these weaker countries, okay? You have to stimulate these weaker environments because they need help. Now, that comes at the cost of a more upbeat environment, okay? Now, let's just say before the euro goes bust, let's just say it falls to 75 on the dollar, right? So right now we're at 1. Let's just say we fall to 75 on the dollar. The DXY is 130, okay? And let's just say that the Japanese yen falls to 4 tenth of a cent on the 4 tenth of a yen on the dollar. We're at 140 now, pretty much. Okay. And that would put the dollar index way up here. And that's a problem that we have, right? We have an issue now where we have to make sure that if we're holding dollars, again, our dollars are going to globally gain strength as the liquidity seeks dollars. In the case that listen, if people start to believe the euro is broken, what do you think is going to happen to the euro? Self-fulfilling prophecy, right?
Yeah.
And
Well, then,
and
so what is going to stop this though?
I think that
There-
I
It
think
has
the
to stop at some point. Like,
yeah
are they going to reweight all of this, or
no, I think that they're going to break out the euro the same countries that were part of this before, right? The euro, the EU, like all those countries that were rolled up into this 57% weighting, they're going to
yeah?
break back down. You understand?
So you think for cash to not be king anymore, the euro has to dissolve,
Yeah. I really
and
do
there's
think
no other way? Like this, I feel like there's got to be a better
well
way to
well
pull the dollar back
well
down.
no, there's a way to pull a dollar back down, right? But I'm saying in general, I don't know if again, listen, I told you from the beginning this would be more opinion. I don't know if the dollar's going to ever print under 90 again. And because just remember what has to happen. These okay, the ECB would have to tighten so aggressively, right? But they've been at negative interest rates for so long. They're doing things, they're taking immense steps in the opposite direction they have never really done.
Yeah, they essentially have to do a crippling recession, raise rates more than the states, right? And then
Yeah, like okay, let's take a look at euro
because
US
it's all
dollar.
relative, right? So
Right.
they
This is
have to
your
act tougher on inflation for their currency to strengthen against the dollar.
this is euro US dollar, right? If the dollar for the dollar, and let's overlay the dollar, right? This is 50% weighting. That's why we focus so much on the euro. For the dollar to get back to where it was in March, okay, of 2021, that 90 area, the euro the euro needs to go back to like 1.25. What's going to create that is the bottoming of is the peaking of inflation. But how could the euro truly have like again, unless they decide to somehow not stimulate? Like, this comes back to the easing and it's a big mechanical cog. Every time you push one lever, another lever gets pulled, and you have to balance them out. And I don't think on a multi country scale, right? Like on a what the euro is, I don't think that's stable over time. But that's my opinion. Now, listen, that's not really going to change the way we handle our portfolio, but it's something to certainly understand when you see people like David Hunter saying the dollar is going to roll over. Okay, he just recently tweeted that the dollar is dollar's making its. He said something about the dollar double topping or some fucking nonsense, right?
Well, I
Um,
mean, he's been saying the dollar is gonna be topping for, like, the whole year,
yeah,
so
you have to
he's already
also
wrong.
you have to understand this, right? Let's just say next year. Let's just say next year is 25 is a quarter as bad as this year in performance wise, right? And let's bring this back to here. So if it's a quarter performance percentage wise, so if 25% of these year to date declines happen again next year, in the case that inflation is truly not under control, right? Just saying, DXY goes up to 112, right? Doesn't seem like, oh, it's not too bad, right? We're at 108 right now, so it's 112. It's not too bad. But the problem is that the higher and longer the dollar stays at these higher levels, meaning that means that the component currencies are at the bottom of their ranges for longer and longer and longer. The longer the euro um, is under parity, the more and more faith is lost in it. You understand?
Yeah.
So at some point, if the euro starts really faltering and starts to break, the bid for dollars is going to be unfucking real.
Hmm.
Now, I'm not telling you that this is going to be happening tomorrow, this week. And listen, I could be wrong. The euro may never default. The euro may be able to pull this shit off. But all I'm telling you is that you have to understand the reasoning on why the dollar is the way it is. The dollar is the way it is because of its components. The reason the dollar's at 108.93 is because all of its components are shitting the bed. And more importantly, its major components are shitting the bed. Okay? These can turn around, but let's look at it from a macro standpoint. The euro is going to turn around, right? Well, they have to do immense tightening. They have never really done such an event. Okay? The yen, they're 13% of the 14% of the dollar. They refuse to do any tightening. They say they got to keep
Yeah,
easing.
they've been refusing to tighten for years.
Right. So, and they're doing yield curve control. They're doing the whole
Yeah, so
alphabet.
they're pretty much scratched off. That's not turning around.
Right.
And
So,
we got the British pound. What about them?
well, we'll see. I mean, I know that they had just they've changed their prime ministers over there. They have obviously the queen has passed away. Sad, R.I.P. to a legend, right? But they need they if let's pull up the pound right now. They have the same issue that the euro has in a certain way, right? They're trying to Brexit, they're trying to do all this shit. But if you look at the British pound against the dollar, it's been pretty much going down. So you have another component that has really not put in a solid move higher. Now there's other like their banks. Obviously they want to fight inflation just like every other central bank. But regardless, like again, um, let's look at a currency that is let's go euro, right? Just add this on here. It's actually worse than the euro since the let's go to 2000. Yeah, it's doing worse than the euro.
Yeah, interesting.
Yeah, so again, this comes back down to like these are major components. Like I said, these are 83% of the dollar, these three guys, these three pairs. If they continue to decline even proportionally just at 25% rate of what they've done this year, next year, the dollar is going to still continue to get stronger. And if
And
there is a default issue with the euro, I promise you, everybody remembers Luna. That's going to be the fucking euro. Okay.
it's gonna be a shit coin.
Mm-hmm.
But okay, so how does this come into effect with regimes?
Right.
So
So
if we
now,
get deflation,
yeah, that's just more
deflation's
power.
gonna make this even worse, isn't it?
Yeah, that's just more power to the dollar because deflation, you know what that means? That means the United States or the US dollar environment has gotten inflation under control.
Yeah.
Now, not only is
So even
inflation,
more
yeah,
would flock towards it.
now even more would flock towards dollars. Number one, inflation's under control. Number two, um, things are just going to start shitting the bed aggressively. So now people are going to want dollars in general, right? Like
Yeah, no one's gonna hold equities, so they're gonna pull it out and put it
commodities,
into
right?
yeah, no commodities, which a lot of money is in commodities right now, as you can see.
Yeah,
Um,
and the
so all the money is going to be going towards cash and bonds
right? And
during deflation.
what ends up happening is you also see a sturdy bid for the dollar because the bonds are trustworthy. America's bonds are trustworthy, right? Now, not like I said earlier, every country's bonds are considered to be trustworthy, right? To a certain degree, like the country's going to pay back the debt. I mean, listen, there's a few that are defaulted, but when it comes to the United States, like people genuinely believe that the United States will pay back the debt without an exorbitant amount of inflation in the process. Meaning they're not going to print their way to 85% inflation to pay your debt back,
Hmm.
right? That's a
Yeah.
general understanding of US debt. Now, Argentinian bonds, different story, right? You bought Argentinian bonds 5 years ago. I mean, you're holding the fucking bag right now. And
Yeah. And so back to the regime question, if we get a risk on or inflation regime,
right.
how would that affect the performance of the dollar? Is that going to pull the dollar back?
I think it will to a certain degree, but like let's look back at the general trend, right? Let's look back and we'll use the euro again for this. And I know I sound super bearish euro, like oh my god, like I'm gonna you guys are probably gonna come back if the euro ever does a bounce. You're gonna say, oh, you fucking wrong. But guess what? Like at the end of the day, um, I'm just using. I'm a mathematical guy, a statistical guy. Most likely, this idea of a blanket currency that covers multiple countries will break at some point. It's just the odds. There's a reason again why we don't have a world a dominated currency like one currency. There's a reason why we have many currencies. This again playing with the odds of what's going to happen. The ECB is dealing with too many variables to account for, and that's the problem here. But let's look at the euro, right? The euro can bounce, let's just say even to 125, even to 114, even to 110, whatever, it bounces. Okay. That puts some downward pressure on the dollar. But for you to get real dollar destruction, which what you're talking about, right? Like the dollar going back down to what's fucking crazy is the dollar going back down to 100, 102 is still bullish trend.
Yeah. Yeah, it needs a huge reversal
Right.
to get back down to bearish trend.
Right. Now, what could help this is if we do get a dramatic risk on regime, everyone's shedding dollars, right? Because they want to own whatever it is. And dollar supply falters, then yeah, maybe you get a bid to life in some of these currencies. But I think, like I said, the fundamental major components, specifically the euro and the yen, are fundamentally broken within the dollar index. And I think that over time, I mean, okay, JPY USD, look, you can't like this is 14% of the dollar index. Let's look at this. Problems, right? This is
Yeah,
problems.
literally since 2008, never really recovered.
Yeah, since 2008, and we're still seeing this. And again, this is more and more stimulus. Like, look, does this thing go back down here? Before you know it, this thing will be under its lowest point since '98, and then we got the lowest point since '90s on deck. This is for
Dude,
like,
and then we got the IPO.
yeah. Then
It's
we
gonna
got the,
break through the IPO price.
yeah, exactly. And I listen. I'm all for wanting stability. I want these. Look, I don't want any inflation across the board, but look at these figures, man. Look at this. 19% down year to date on a currency. On a
Yeah, that's
currency.
nuts.
Yeah.
So there you have it, guys. That's that's our bull case on the dollar.
Yeah. And listen, like I said, anything can happen. Understand the concept. Understand that. Just for example, if the dollar were to go bullish, a bearish trend, right? This is my theory, what I just explained to you in the last 40 something minutes. I'm not going to prevent the theory from letting me take advantage of the market regime at hand. I'm just telling you that the more and more these countries degrade their currencies, the harder it is for them to come back to life over time. And
Hmm.
that is going to put a permanent mark on the dollar and the direction it's headed. Now, how that plays out, I love to watch, and I hopefully we're still making podcasts when there is a some type of huge liquidity event in the dollar, either up or I should say, market moving event in the dollar up or down. I'd love to talk about that and see how that plays out. But I can tell you right now that the components of the dollar are just not where they need to be, and hopefully something changes and they bring things back down. But a continuous rise in the dollar is just going to again perpetuate more dollar demand, more treasury demand. So again, down the road, we will eventually get, if we do have a euro problem, we will have a massive rally in treasuries. But that again is more um, hypothetical. The regime at hand is stagflation. Likely we're going to get deflation next. If we don't, we're going to get risk on. Dollar could go down. But I'm just telling you from a macro standpoint with the components and the situation that weighs out in the dollar where it looks like. And I hope you guys are able to take advantage of the information I gave you, get a better understanding of why I'm telling you these things. And going forward, keep an eye out for certain things like the ECB, what they're doing, the language from the BOJ, even what Britain is doing, and put it all together and say, maybe you're living in a country and you're listening to this and you have euros and you're getting extremely offended by what I'm saying, and I'm sorry if I'm offending you, but maybe you too can also sympathize with me and understand what I'm talking about. And if that's the case, maybe owning US dollars is not a bad thing. Maybe having a share of your of your assets, of your hard-earned money that you work for 9 to 5 Monday through Friday every day in dollars is not a bad idea. Because even if the dollar takes a shit, is it really going to take a shit unless the fundamentals of the components are drastically changed? And I think that's where we
Yeah.
can leave the podcast off today, right?
Yeah, I think that was great. I
Okay,
learned a lot too.
awesome. I thank you guys again for coming in and listening. If you have any questions, visit us in our Discord or our Twitter at the Market Radar. The Discord can be found at www.market-radar.com.